I'm Jay Pelham, representing Kaufman Rossin Insurance Services. Today I am joined by my colleague, Jared Kornfeld, for a brief discussion about the benefits of buy-sell agreements.
Thanks, Jay. I'm looking forward to our discussion.
Our conversation today will focus on why it's important for business owners to have a buy-sell agreement in place. And while there are strategies for single-owner businesses, today we're going to focus on the scenario where there are two or more owners. Jared, can you please explain what a buy-sell agreement is and why it's important for a business owner to have one?
Sure. Let's start by saying that you should definitely consult your tax and legal advisors before preparing a buy-sell agreement or revising an existing one. With that said, buy-sell agreements are designed to help business owners protect what is typically their most valuable asset, their business. These agreements generally specify the financial terms for one shareholder to purchase another shareholder's shares in a business. The agreement usually stipulates a method for valuation at the time of sale. Now, depending on the size and value and complexity of a business, this can range anything from a set price to hiring 3 separate accounting firms to do valuations and then taking an average. A buy-sell agreement should also discuss other potential triggers for a sale, such as disability, retirement, termination, bankruptcy, divorce, and maybe even a deadlock provision. Take the steps now to protect the future of your business and review these plans often.
While having the right agreement is part of the equation, generally, that agreement needs to be supported with life insurance for the benefit of each shareholder to complete the equation. There are 2 types of structures to support these plans: a cross-purchase plan or an entity plan. Jared, could you take a moment and tell us the difference between these 2 types of structures?
Sure, Jay. A cross-purchase plan is typically when there are 2 or 3 business owners. Under a cross-purchase agreement, life insurance policies are generally owned by each shareholder on the life of any other shareholder. There are typically some tax advantages to this structure, but it could get cumbersome with larger or growing amounts of shareholders. An entity purchase plan is often used by businesses that have 2 or more shareholders. It involves the company taking out life insurance on each shareholder in the amount equal to the value of their stake in the business. Should one of the shareholders die, the proceeds from the insurance policies are then used to buy them out. Now, premiums are generally not tax deductible, but the death benefit proceeds are received by the beneficiaries tax-free.
Thanks, Jared. So now we've talked about the what and the how. So let's talk about the why it's important to have a buy-sell agreement supported with life insurance for the benefit of all parties involved. For example, a surviving spouse or children will now have the benefit of cash proceeds from life insurance rather than an illiquid asset like ownership in a business. The remaining shareholders will now have a predetermined price to buy out the heirs and won't have to go through a process to raise funds to be able to consummate the purchase.
It's also important to consider that in the absence of having a properly funded buy-sell agreement, you could end up with someone having a significant ownership in a company that operates in an industry or segment that they do not have any direct experience in.
And for many business owners, the ownership in that business is their biggest asset. And that's why it's extremely important to protect that asset with a buy-sell agreement supported with life insurance. Well, that's all we have time for today. Thanks for joining, Jared.
Thanks, Jay. It was a pleasure being here.
And thank you for watching. Please stay tuned in the future for more videos from Kaufman Rossin Insurance Services to help support individuals or businesses. Please don't hesitate to reach out if we can help.